Hello, everybody. Welcome to today's episode of the Daily Dose. Today is July 14th, 2022. We saw a lot of interesting things today. The markets opened down heavily and rallied for most of the day, but they did still finish in the negative. A lot of warning signs coming from inflation and the Fed still, so I think the markets are still contemplating a lot of that. So if you were with us yesterday, you would know that JP Morgan and Morgan Stanley were two big banks that were reporting on earnings today. JP Morgan reported a wider than expected drop in their second quarter profit of 28%, attributing the decline to a $1.1 billion in provision for credit losses amid concerns over a possible economic downturn. So their shares slid as much as 5%. And their CEO, Jamie Dimon, got into it more. In our global economy, we're dealing with two conflicting factors operating on different timetables. The U.S. economy continues to grow, and both the job market and consumer spending and their ability to spend remain healthy. Now, don't really know how true that is because the jobless report came out today, and we are starting to see more jobless claims coming in month over month. So that might be showing that the job market is actually cooling off amid this looming recession. He goes on to say, but geopolitical tension, high inflation, and waning consumer confidence are really playing into this never seen before or not seen in a long time quantitative tightening. So I do think that what he said up here is true to a sense that the job market is still hot and consumer spending is still high, but I would really attribute a lot of those job openings not being good paying jobs, and people aren't going, the job numbers weren't good because there were a lot of good jobs available, but because there were so many people unemployed during the COVID crisis, and a lot of people died during 2020 and 2021. That there's just so many jobs available and that people are taking them. Now, as far as consumer spending is going, I wouldn't necessarily say that discretionary spending is still hot. Seeing higher numbers as far as consumer spending goes might be attributed to the fact of high inflation and that people are just spending more money, but they're still purchasing the same amount of goods and services that they need to live. It's just that those cost more now. So I wouldn't really be as optimistic as he was saying about the consumer. Morgan Stanley also revealed results that missed analyst expectations. And those two reports were accompanied by Citi and Wells Fargo also falling today, being in the financial industry. So we did get the jobless claims report today, and we did see higher numbers than last week. So that could be a potential sign that the labor market may be cooling. Although that the Fed said that they were posed with the question of what would they do in a scenario where inflation was still a problem, but they saw the job market start to cool off and unemployment numbers going up, and Jerome Powell, he really stuck to his mantra through all of this, which has been that they're doing everything in their power to get inflation under control. So that kind of points to the possibility of unemployment maybe starting to go up if we start to really find ourselves in a recession and the Fed still aggressively tightening the economy. And that would be interesting. So we definitely don't want to get into a hyperinflation type of scenario because that would just be devastating for not only the United States economy, but the global economy if the United States went into hyperinflation. So that'll be interesting to keep an eye on. The producer price index for final demand, this is a gauge for wholesale and business prices, surged 11.3% year over year in June and 1.1% over the prior month. So even with the prices of oil falling, it doesn't seem to point to overall inflation also falling. It looks like inflation for now is still on the rise and is getting to dangerous levels. So here's just a recap year to date of the indices. We typically look at this every day. We're still in bear market territory for the NASDAQ and the S&P 500, still in deep correction territory for the Dow Jones. The Dow Jones is in green here, the S&P is in blue, and the NASDAQ is in pink. So you can see that the NASDAQ is suffering the most, and that's more tech stocks, growth stocks, and then you see the Dow Jones being a lot more value, a lot more financials, and that's why they're on opposite sides of the S&P 500 here. So markets had a knee-jerk reaction after the eye-popping inflation numbers. I think a lot of people were expecting the inflation numbers to start to look a little bit better, and they didn't. And today we got the headline that we could even see a rate hike of 100 basis points. We already saw that a 75 basis point rate hike for the next Fed meeting is likely, but for the first time now they're throwing around the possibility of a 100 basis point rate hike. And we haven't seen that since the early 90s. So it's been about 30 years since we saw rate hikes this aggressive. And with the Fed wanting to tighten the economy like this, as aggressively as they are, if we do see unemployment start to go up and more signs that we're entering into recession, and we start to go into an economic climate where the Fed would usually start implementing QE, which is just quantitative easing, which is the opposite of what they're doing now, it would be interesting because they are saying that they're committed to fighting inflation. And I think a lot of people do believe that that's the biggest priority, is to fight inflation. But it could really hurt the average American consumer, and it could affect a lot of more asset classes than that are suffering right now, such as the housing market, which is yet to bust. So that'll be interesting to keep an eye on. Let's take a look to see what the market did today. So this is where we closed yesterday. We closed at about 38.01 yesterday. We opened at about 37.54. So we opened and sold off. We were about 2% down here at the lows, and then we just rallied all day and bought back up. We didn't quite get back to where we closed yesterday, so the S&P was still down about 0.3%, but it did rally throughout the day. And we've been seeing this. This has been a trend this week especially, where the market opens and sells off really aggressively in the morning and then kind of rallies through the rest of the day but still finishes in the red. That's kind of a trend we've seen throughout this week. So we saw more of that today, although we didn't see as heavy selling at the end of the day as we have previously in the week. As you see, yesterday we got some selling at the end of the day. Tuesday we got a lot of selling at the end of the day, but today we didn't really see that type of selling at the end. So that was interesting. I kind of just stabled out at the end of the day. I want to take a look at Bitcoin. I added this trend line to the chart. So this trend line goes from the previous sell-off about in the beginning of April through now. As we saw, Bitcoin has been kind of rallying the past couple of days, or holding steady in this little zone since it sold off in June. And I think we should get some clear direction in the coming days with Bitcoin. If we break higher than this zone, then we could see a return to 28, 29,000, maybe 30,000, somewhere up in this level. And if we sell off, well, it doesn't look good. I mean, it could get to 18,000, 15,000, after that, 11,000, 10,000. So Bitcoin's not looking good, but I think we'll get some clear direction on it soon. Hopefully, it'll get better, as it's been forming a base for the past couple weeks since this sell-off. But I wanted to add this trend line in so that you could really see what's happening here. Like it's gonna find some direction soon. So that'll do it for today. Thank you for joining me. We got that bombshell of a headline that the Fed might raise interest rates by 100 basis points next Fed meeting, even though that unemployment looks like it's starting to be on the rise again, and we continually get signs that we're either entering into a recession or already in a recession. We saw that the yield curves are already heavily inverted, where jobless numbers are going up, but the Fed is remaining committed to fighting inflation. So keep an eye on that. Make sure to join us tomorrow for the last daily dose of the week. Make sure to join us on Saturday for your weekly wrap. That'll do it for today, and thank you for joining me.